This all takes us now to our talk of the tape, how aggressive the Fed might have to get, what it means for your money, where do we go? A lot to discuss, so I'll shut up and we'll jump into it. NewEdge's Cameron Dawson on set with us here, and Truist Keith Lerner also joining us remotely. Good to see both of you. Big day, need a steady voice. Cameron, first to you. The jobs number wasn't that horrible. It feels like, we brought this up on the noon show, a little bit of a market overreaction.
Well, 114,000 really isn't that bad in the grand scheme of things. It depends on what you think the neutral number of jobs should be. If it's 150,000, 114 isn't bad. If you think we should be closer to 200 to 300,000, then that 114 is pretty bad. If we think about this reaction, we can't forget that there's a lot of positioning happening here. And that positioning unwind is likely why this move is so magnified.
Yeah, because, and I think Cameron nailed it, Keith, because I've been doing this a long time, my man, you know that. And yeah, we slight miss on the jobs number, and the market does what it's doing. That, to me, is not about the jobs number or the Federal Reserve. It's what Cameron said. It's about positioning. It's about hedge funds. It's about this yen NASDAQ carry trade unwinding. If I'm wrong, tell me, would you agree?
Well, first, Brian and Cameron, great to be with you. My head's spinning with all these different cross currents in the market right now. I do think it is somewhat of an overreaction. You said you've been doing this a long time. I've been doing this a long time. The jobs report day tends to be an overreaction, and you also have to look at the trend because this number is revised 1, 2, or 3 times. If you look back over the last 3 months, Brian, the average job growth is about 170,000. That's close to the pre-pandemic trend. But also, we have to realize we had a big first half in the market. As Cameron mentioned, positioning was a bit stretched. And even after you have that big first half, the second half, you tend to see gains, but there tends to be hiccups along the way with an average pullback at some point of about 9%. So I think we're in that corrective period, but we still think the bull market trend is intact. It just is going to take a little bit to get through this kind of choppier period.
And you had noted, Cameron, to me that all these sort of technical traders, right, they were all long. Yeah. It's like 99.9%. That's almost all of them, 99.9%. They were all long. They got to unwind that. And you pointed out, and this is fascinating, that the markets today sold off almost perfectly to their 50-day moving averages.
Yeah, 50-day or 100-day moving averages, depending on what index you're looking at. So you look at the Russell 2000, corrects to its 50-day. S&P 500, right to its 100-day. The SOX index, semiconductors, right to its 200 days. So the biggest test next week is how we react off of this moving average. Do we bounce off of that, or do we drift lower, meaning that this correction is deeper and more protracted? We really can't judge that until we start to see this bounce, but we would note markets aren't technically oversold yet, which would say that maybe there is some more churn to come.
More churn to come. Listen, it's a traditional day, and I know it sounds weird, Keith, to say that. Gold is over 2,500. The utilities are up. Apple is up. People are kind of looking for safe places. I won't say safe haven because that's actually redundant. Safe haven. Safe places to put their money. Do you expect that to then be unwound and we go back to, quote, normal at some point here, Keith?
I don't know if we're going back to normal. I don't even know what normal is. I will say we in our portfolios, we added gold a few months ago, and we think it's going to be a good hedge because geopolitical risk is rising. There's uncertainty about the U.S. dollar. It just made a new high. Technically, it looks great. So in moderation, we still think that makes sense. We're actually overweight utilities as well. But listen, Brian, I think this kind of corrective period, there's 2 components. There's a price component and there's a time component. I think both of those have a bit further to go. I mean, one thing we'd be watching for is following tech. Tech let us down, and often when a correction has run its course, you'll see the leadership or you'll see what brought you down start to bottom. We haven't seen that yet. I think what's also notable, 2 weeks ago, everyone was talking about, hey, small caps has had the best, 5-day change we've seen in history, or one of the 5 best. We're back at the breakout point, that CPI day as well. So I'd be watching that over the next week as well, seeing if it can find some support. But ultimately, we do think the market will eventually recalibrate and move higher. I just think in the near term, it's hard to say what the catalyst is, right? We're moving past earnings season. The Fed's in a bit of a pickle because the next meeting is not till September. And then we get into this kind of seasonal period, which maybe in the election period gets a bit,